Over the past 10 years, there has been a great variation in the return from different sectors in the market relative to the overall market return. For an example, looking at the sectors in the MSCI World Index in 2014, healthcare was the top-performing sector with an 18.1% return, compared to energy, which was the worst-performing sector, losing 11.6%, a difference of more than 29% between the top and bottom-performing sectors in 2014. In addition to large differences between high and low-performing sectors in any given year, sector performance varies from year to year, where individual sectors can be the top-performing sector in one year and the worst-performing in the next. Investing in the entire market across all sectors can incur the risk associated with owning underperforming sectors and stocks, which negatively impacts performance. The CROCI sectors indices attempt to mitigate this risk by investing only in the most undervalued sectors and stocks according to the historical CROCI economic PE ratios. CROCI, which is Deutsche Bank's proprietary valuation methodology and stands for Cash Return on Capital Invested, aims to make companies' financial statements and valuations more comparable using the well-established CROCI valuation process. By aiming to select undervalued sectors and avoid those that appear overvalued, the model attempts to avoid investment in sectors that have a higher probability of reverting to lower valuations, which frequently results in underperformance. We begin with the largest companies in the US, Eurozone, and Japan that are in the CROCI database, excluding financial companies, and group them into global sectors. The three sectors with the lowest median CROCI economic PE ratios are selected for inclusion in the index. Once the sectors are chosen, the next step is to select the 10 stocks with the lowest positive CROCI economic PE ratios in each sector to complete the index selection process. On a regular basis, the index is equally weighted and rebalanced to make up the CROCI Sectors Index. It is this combination of identifying and investing in underlying economic value, both at the sector and stock level, that defines the CROCI Sectors Index. This video will walk through the CROCI Sectors 2 USD 5.5% Volatility Control Index, referred to as the Volatility Control Index. First, we start with the Core Index, which is Deutsche Bank's CROCI Sectors 2 USD Index. This is the underlying index which provides the equity exposure in the Volatility Control Index. The next part of the Volatility Control overlay is calculating the realized volatility of the CROCI Sectors 2 Index to determine if realized volatility is high or if realized volatility is low. This is the key to the Volatility Control overlay. As realized volatility of the CROCI Sectors 2 Index rises, indicating increasing volatility in the stock market, the index invests more money in cash, earning the federal funds rate as represented by Deutsche Bank's Fed Funds Effective Rate Total Return Index. As realized volatility of the CROCI Sectors 2 Index decreases, the index invests more money in equities, in our case, the CROCI Sectors 2 Index. The allocation between the core index and cash changes on a daily basis, with the aim of maintaining a target volatility level of 5.5% or lower each day. Let's look at an example to see how the Volatility Control overlay invests money across cash and equities.
The Volatility Control Index seeks to adjust exposure between equities and cash, such that the overall realized volatility of the combined portfolio is approximately 5.5%.
Let's say the realized volatility of the CROCI Sectors 2 Index is currently at 11%, and we know the realized volatility of cash is generally 0%. In this example, the index would allocate 50% into equities and the remaining 50% into cash to bring the Volatility Control Index's target volatility level to 5.5%. If the realized volatility of the CROCI Sectors 2 Index fell to 5.5% or lower, the Volatility Control overlay would move 100% of the money into equities with no money invested in cash to bring the Volatility Control Index's target volatility level to match the realized volatility of the CROCI Sectors 2 Index. To reduce turnover, the reallocation between cash and equities each day cannot be more than 10%. The Volatility Control overlay uses the core CROCI Sectors 2 Index and calculates the realized volatility of the CROCI Sectors 2 Index every day between cash and equities to end up with the CROCI Sectors 2 5.5% Volatility Control Index.
Both the CROCI Sectors 2 Index and the Volatility Control Index have risks you should consider before purchasing a financial product linked to either index. The CROCI methodology and the strategy of either index may not be successful. Furthermore, the indices are subject to currency exchange rate risk, and the index sponsor may have conflicts of interest with you.